Good morning. This is Tom Alexander. It is Sunday, November 3rd. This is the weekend update that I do every weekend. If you are finding me for the first time on YouTube and you want to be notified when I post something, shoot me an email to tom@alexandertrading.com. I'll put you on the list. I don't sell lists. I don't spam you. Uh, So the other thing you can do, let me show this real quickly, and we'll get into this week's stuff. Um, you can go to the website, alexandertrading.com, click on weekly update. And if you do that, you can see the update for this week and going back, I don't know, a year or two. You can see what I said. You can access the recordings. You can also access a PDF of the charts that I'm going to show in this if you want to print them out and save the levels that we're going to discuss. Okay, so let's talk about what we have in front of us in the upcoming week. We have perhaps one of the most eventful weeks from an exogenous perspective, exogenous to the market itself, that we've had in 4 years. And what is that? Well, it's the U.S. election. Well, if that's not enough, we also have a Fed meeting, the Fed follies, the Fed circus, whatever you want to call it, that they postponed Thursday and Friday because they don't want to share the spotlight with anything and they want it on themselves, which is fine. So the bottom line here is that we're just off all-time highs in most of the primary U.S. trading indices. Uh, we are in a bull trend by any objective measure. And we have, in typical at U.S. indices trading at all-time highs, you have people coming out of the woodwork calling for the grand cataclysmic nuclear Armageddon wave 5, 5, 5, 5, 5, 5 of 5 top and an imminent crash. And then you have people saying, well, we're going to 10,000 on the SPX by 2025. I don't know. I do know, however, that for it to go to zero or to go to infinity, the SPX has to take out certain levels. And that's something we can all objectively identify. And it's what I use to trade anyway, regardless of the exogenous event. Now, if you are a trader, uh, you probably don't have to say this if you've been trading for a while. Next week is likely to be volatile. There could very well be head fakes in both directions. The conditions are there for very random whippy action. That would not be a big surprise. So if you're trading this environment, just know what you're trading. It's also perfectly okay to just stand aside and then wait a week or so and let the dust settle. The market is going to be open week after next and the week after that. And if it's not, then there are bigger issues. Then you don't have to worry about the market. So let's take a look at things, and we're going to start with the primary U.S. indices, the 4 or 5 that I cover that really encompass the entire U.S. equity market. Now this is the SPX, and as I said, we're not far from an all-time high. Let's just see how far we are. So this is the all-time print high to this print low, and that's a drop of about 3%. Big deal, right? Now, the first signal of a change in trend, objective signal, and in technical analysis, there are very few objective things. Frankly, most technical analysis is voodoo and magic. I don't do voodoo and magic. I don't do fundamental analysis either. Actually, I would argue that the analysis I do is the most fundamental analysis of all because it depends entirely on the interactions between buyers and sellers. What are the buyers and sellers doing? And it leaves a footprint on the chart. So we do have, for the first time in a while, we have a lower high and a lower low. So that's the initial signal of a change in trend. Notice I said initial. Now you can have you know, corrections, consolidations, balance areas that form in a bull trend. But this is just the first signal. It's something you have to have or you will have at every change in trend, whether it's a change from a top to a bull trend to a bear trend or a bear trend to a bull trend. So we do have that uh, in place, and I'll just point that out. Now, I think we're in a bull trend. We're in a bull trend until otherwise. Now, if you want to trade from the short side of this market, that's fine. Your stop has to be on a gross basis, okay? This pivot high. Now, I think you can do better than that. I think you can go down in time frame. You don't have to go to a 25 tick chart or something. You can go to a half hour chart or an hourly chart and do this, use the same concept. Um, if you're looking for lower lows and lower highs to confirm the trend or higher highs and higher lows. Okay, so, but if we look at this chart, the most important levels are the levels you see here. This would close the gap to the upside 58.13, and then this is the all-time print high. This is an important level for obvious reasons. So these are all the levels that I'll be watching, initial levels I'll be watching as the week goes on. From a pure price action perspective, these are the levels in the SPX. Okay, the NDX. Now, the NDX has never confirmed this high, so there's been this lingering divergence since the middle of July, with the SPX trading a new all-time high ground, the Dow trading a new all-time high ground, and the NDX, ironically, which has led this bull market for a decade, lagging. So this itself is a divergence. Here are the levels that we want to keep an eye on going into next week. Okay, if we look at the Dow, you can see we're off. Let's see how much we're off the all-time high here. We're off the all-time high a little less than 4%. And we've already taken out this level here, but we bungee jump back up above it. That's not unusual. But here are the levels, nevertheless, that we'll be watching next week. And then if we go over to the Russell, which is a hot mess and has been a hot mess for years, here are the levels in the Russell. And then last but not least, the broadest of the indices, the New York Composite, that is all the stocks listed on the New York Stock Exchange. Now, this is an interesting chart to me, very short term, because we had this gap up in the indices on Friday and this furious rally, and then we inverted V topped, and the New York Composite closed really close to its low. I mean, it closed right here. And below this level, you're in an elevator shaft, big time. And you don't have this nice, clean, higher highs, higher low pattern in the New York Composite. You basically have an inverted V top at this point. Now, at some point, even if we go lower, you'll get a rally and you'll have that lower high. But right now, it's pretty much straight down off of this high. Okay, so that's what it looks like from a pure price action perspective. Now let's take a look at some simple things, technical things that I use. I'm gonna come back to this because I'm gonna spend some time on this. Let's go to VIX. VIX, and I've been talking about this for weeks. VIX has been elevated really since mid-July. It has in declines and advances. It has been elevated. It closed Friday at not just below 22, and you can see the 10-day moving average of VIX is elevated. So this is interesting, and I think it reflects the uncertainty that we have because this election next week, as well as this Fed meeting. Now let's look at something else that I think is really interesting. And this is one of these things that is correlation, not causation. It is a blunt instrument. The red line you see here is a 10-day moving average of NYSE advancing issues. The green's a 5-day moving average of advancing issues, and the blue histogram is closing breadth. Breadth closed on Friday negative 239. it has been fairly neutral. But overall, you can see the 10-day moving average of NYSE advancing issues is rapidly approaching what I consider to be a lower extreme. Now, it's not quite there yet. It's actually at positive 1102. So I'm going to highlight exactly where it is now. Okay. Now let's go back and bear with me. And based on this alone, one could conclude from correlations between this particular indicator and price that time wise, we're close to a low. Now, what gives me a little bit of pause in saying that is that we're not even just barely 3%, right at 3% off of this high. That's not much decline. Now you can say, well, gee, that's this huge divergence here showing weakness in the broad market. Yeah, that's one way you can read this, no doubt about it. But let's just go back a few years and look at what happens when the 10-day moving average of NYSE advancing issues reaches into this level. Here is an instance, and we went a little bit lower here, but not a lot. And within 3 or 4 days, we began a furious rally. Okay, here we went a little bit lower. The market bottomed and began this bull run. This was sort of a bear trend. And by the way, these green arrows are negative 2000 closing breadth readings. Okay, and you can see how rare those have been because we've been in a bull market. But even in bear trends, when you get the 10-day moving average down around this level, you're usually near at least a serious bounce. And in this decline that we had that began in July of 2023, that was about not quite 11%. You did have these bounces of relative significance when this 10-day moving average of NYSE advancing issues reached down to this level. Here's another instance, and this almost coincided with the low. Here you had a bounce here, and then when it crossed here, right here, you were within a few days of a low. Now that low got taken out, but you didn't have a whole lot more price damage. And this was all in this was coming off of this top, and some say this was a bear market. Uh, I don't know what your definition of a bear market is. 27% is a pretty healthy haircut. But even in this off of this top, when the 10-day moving average of NYSE advancing issues reached down to this level, you had some serious bounces you can see here. So let's go back even further. Now, I'm not going to get into this because it's rather tedious, but I've done this in the past. But even in this quote unquote crash that we saw back in 2020, you had furious rallies off of these lows. And of course, this was a pretty historic decline in a short period of time. But this was sort of an exceptional circumstance. And yes, so we can go back, and here we crossed here. Now this went lower by a healthy amount on a percentage basis, 5 or 6%, but it did so in about 5 or 6 trading days. So that's my point. I guess we're going to find out. We're coming into a week where we could have some severe selling here, but if we do, frankly, I'm not. I think you'll get a serious bounce out of it. And one thing is for sure, I think within the next 7 or 8 trading days, we're going to have a good idea about the overall tenor of the U.S. stock market, because in 7 or 8 days, hopefully, it will have digested the election, even if the election is not over with on Tuesday night, which I mean, who expects it to be right? And then you have the Fed stuff on Thursday and Friday, and then maybe some digestion there. So it might be into Tuesday, Wednesday week before we have a good idea about the labeling this a bull market or a bear market. But this is really interesting to see the 10-day moving average already at this level with the SPX only off 3%. Now, if we are entering a bear market, that's not a big surprise. And, we could spike lower another 2 or 3% before you got to bounce. But again, we're just going to have to take it and see what happens in real time. So I hope you're not disappointed that I don't have some dramatic price prediction telling you that the SPX is going to hit 5587.23 at 10 a.m. on uh, Wednesday morning, but that's not what I do. We do have lower lows and lower highs. That's the pattern that we want to watch. There's a big gap here. That's something to watch. You're in an elevator shaft below 56.75 in the SPX. That's something to watch. Next week should be entertaining. It should be fun. By the way, if you've gotten this far, I would very much appreciate it if you would like the video, if you would subscribe. You guys have a wonderful week. It's going to be an interesting week. It's going to be fun. We'll see you later.